Top 5 Safest Investments Right Now. Investing can help you secure a more stable future by allowing you to save for retirement or to help you weather a temporary financial storm. Investing is essential because it increases your wealth, increases your purchasing power, and helps you achieve your financial goals. It's also possible that you just sold your house or recently came into some cash. Putting your money to work is a smart move. We will reveal some safest investment plans in today's video, so let's get started. Number 5. Shares of preferred stocks. A preferred stock functions like that of a hybrid between common stocks and bonds. Specifically, it provides some of the opportunity for appreciation that you receive from ordinary shares, while simultaneously giving the consistent income payments that you receive from bonds. The dividend payment on preferred stock are typically larger than those on bonds issued by firms. It is because preferred stock dividends payments are not guaranteed, unlike bonds. Since 1900, preferred stocks have provided investors with estimated yearly returns of more than 7%, most of which have been in the form of dividend payments. In addition to receiving dividends, the value of your investment may increase as a result of a buyback, because preferred stocks often pay greater dividends and, as a result, cost corporations more than corporate debt. Many businesses have recently begun purchasing their preferred shares, typically at a price that is slightly higher than the price at which they were originally issued. Number 4. Treasury, including notes, bills, and bonds. Your first and best choice is to invest in government bonds if you want to receive an interest rate slightly higher than a savings account without taking on a significant amount of additional risk. Treasury bonds currently yield anything from 2.22% for 1 month to 2.93% for 30 years as of August 2022. Bonds that the United States Treasury issues carry a lot of weight since they're backed by the complete faith and credit of the United States government. The United States has a long tradition of honoring its financial obligations. If you require access to your cash before the debt is mature, this makes government debt more dependable and easier to buy and sell on private markets. Because of this stability, however, bonds may have yields lower than the rates you could earn from bonds in which it was less probable that the debt would be paid back, such as with bond funds. Number 3. Money market investing. Mutual funds in the money market typically purchase overnight commercial paper and other short-term securities. Even the greatest money market funds often provide very little yield for their investors. On the other hand, money market funds provide investors with absolute liquidity. They experience almost no volatility, and you may withdraw your money whenever you want. It sets money market funds apart from treasury goods and corporate bonds. It is also important to note that most financial institutions now provide access to money market mutual funds. Even if you don't have a brokerage account or don't wish to open one, you may still be able to invest in money market funds through your local bank. If you're enjoying this video, please hit the like button and subscribe to our channel if you haven't yet to show us your support. Now let's continue. Number 2. Shares of common stock that distribute dividends. Those looking for a higher income in the current context of low interest rates have options other than preferred stock, as well as some common equities that are considered relatively safe. Real estate investment trusts and utility shares are at the top of the list. Both of these equities have been seen as safer, less volatile, and more reliable in terms of their dividend payments. According to data from the Stern School of Business at New York University, the average dividend yield on REITs as of August 2022 was 1.04%, whereas the average dividend yield on utility stocks was 2.93%. When selecting common stocks to invest, it is preferred to stick with powerful, solid names that have been around for years and pay consistent, reliable dividends, rather than growth stocks that live and die based on investor enthusiasm. It is true regardless of the industry in which you choose to invest. It is important to keep in mind, however, dividend payments on common stock are not guaranteed, and just like any other asset, you risk losing money if you invest in it. Number 1. Index funds. Individual equity holdings, such as regular and preferred stock and bonds, do not qualify as diversified investments. Because you can only purchase stock or bonds from 1 or 2 companies, investing in them is inherently fraught with danger. What will happen if those companies are unable to continue operations? Investing in index funds allows you to put your money into hundreds, even thousands of different equities and bonds. When you invest in something like this, your risk is much reduced, yet you still benefit from increased interest or dividend rates. PIMCO's bond fund and Vanguard's BND, or dividend appreciation funds, are examples of diversified funds that offer greater interest rates. When you buy stocks, including those that pay dividends, you risk losing money, as is the case with all stock investments. You should have a savings account full of easily accessible funds in the event of an unexpected expense. However, there are alternatives for capital that must remain accessible, but on which a better return is desired. Even when interest rates are low, there are low-risk, high-yield alternatives to grow your money, such as money market mutual funds, insurance, government, and strong company debt. Well, that's all for today's video. Tell us in the comments section how this video was. I hope that you found this one interesting. If you want to see more videos just like this one, please consider subscribing for more. And don't forget to give comments and provide us with your valuable feedback. We'll see you in the next video with some more interesting facts and stories. And until then, stay tuned.